Thank you, Tracy. Good afternoon, everyone. I'd like to officially convene today's CFPB Academic Research Council meeting, or ARC. I'd like to welcome all ARC members as well as members of the public that are joining us today. Thank you for making time. My name is Manny Magnon, and I serve as the staff director for the Advisory Board and Council section here at the Bureau. Today, I'll be serving as the designated federal officer for this advisory committee meeting. As background, the CFPB established its advisory committees to provide substantive information, analysis, operational expertise, knowledge of their communities, and feedback to inform the Bureau's work. The ARC is comprised of economic experts and academics with diverse points of view. You can find a full list of the Bureau's advisory committees on our website at consumerfinance.gov. As a reminder, the views of the ARC members are their views. They are greatly appreciated and welcomed, yet they do not represent the views of the Bureau. Now I'd like to go over what you can expect during today's meeting. Today's meeting will run from 1 p.m. and conclude at 4:15 p.m. Eastern Time. We'll start with remarks from the Bureau's Acting Director, David Waggio. Our first agenda item is a discussion on COVID-19 emerging issues and data analysis. The second item is a conversation about 2020 HMDA mortgage lending data. The final item is a discussion about research partnerships. Following each session, there will be time for Q&A and discussion with advisory committee members and Bureau staff. During the call, we'll have two 15-minute breaks. As a reminder to Bureau staff and advisory committee members, during the Q&A sessions, if you would like to make a comment, please press the raise hand icon and research staff or the ARC chair will call on you. Please drop the raised hand once you have finished speaking. Before you speak, please be sure to unmute your line and provide your name, title, and organization. Please be sure to mute your lines when you're not speaking. Everyone should have received an email from my team with the meeting materials, including the agenda and the presentation. Please open those documents now so that you can follow us through the meeting. I am pleased to introduce David Waggio, who was appointed by President Biden to lead the CFPB as the acting director. Since joining the Bureau in 2012, Acting Director Waggio has served as the Bureau's acting chief of staff, as lead for talent acquisition, and most recently as the Bureau's chief strategy officer. Prior to this time at the CFPB, Acting Director Waggio served at the National Institutes of Health, the Office of Personnel Management, and the Office of the Secretary of Defense. Please join me in welcoming Acting Director Waggio to today's discussion. Acting Director.
Great. Thanks, Manny, and good afternoon to everyone. My thanks to you all for joining today's Academic Research Council meeting, and my thanks to Joshua Wright for his continued service as chair of the ARC. Every time ARC meets, you provide us with valuable insights and help us to see data in new ways. Your efforts improve our abilities to establish priorities and make policy decisions that keep markets fair and competitive, as well as protect and empower consumers. So thank you all for your contributions. Our first session today will focus on the emerging effects of the COVID-19 pandemic on consumers. We will then move into a discussion on racial and economic disparities in Home Mortgage Disclosure Act data. Finally, we will discuss new and ongoing research partnerships. When I began as the CFPB's acting director, I said one of my two main priorities is seeking relief for consumers facing hardship due to the COVID-19 pandemic. Since then, multiple vaccines have rolled out to fight COVID-19. Almost all schools will be open this fall, and most people are either heading back to or actively searching for work. But the fast-spreading Delta variant has refused to give us an opportunity to fully recover financially, physically, or psychologically. In this middle ground, consumers seem to feel the sun at their backs as they cautiously watch storm clouds forming just ahead. And so we need to ensure we are helping individuals and families participate in the recovery while doing what we can to protect them from future financial shocks caused by the pandemic. Back in March of 2020, the government knew it had to act to keep families in their homes. 18 months later, housing remains a key priority. As various federal foreclosure moratoria and eviction bans end, many of the adverse financial effects of the pandemic are catching up to millions of families who now owe potentially 18 months of deferred mortgage payments, or over a year's worth of monthly rental payments. So despite seeing the country's GDP return to pre-pandemic levels, we must continue to provide support to individuals and families who are recovering and yet not fully recovered. Following past recessions, some policymakers have focused on macroeconomic data to determine whether the country has recovered. Ignoring regional and household data can cause families and communities to be left behind. In fact, less than a year prior to the start of the pandemic, researchers from UC Berkeley's Institute for Research on Labor and Employment argued that stagnating wages and increasing inequality showed that many parts of the country had never recovered from the Great Recession. And right as the Great Recession hit, the AFL-CIO published an article arguing that many workers continued to feel the effects of the 2001 economic crisis. That we seem to always have people trying to recover from the last crisis when the new crisis hits tells me that we must focus on transitioning consumers and families to this post-pandemic economy so they reap the benefits of the country's current economic growth. We have taken steps to do just that. On August 31st, temporarily amended mortgage servicing rules will go into effect. The rules are designed to prevent avoidable foreclosures while ensuring the housing market remains open, fair, and competitive. We want all qualified homeowners to know their mortgage options and to have time to make the decision that is best for them and their families. For renters, we recognize that many families continue to face the threat of eviction, rent arrears, or both. We want families to find appropriate housing, and we do not want actions outside of their control to stand in the way. As such, we released an enforcement compliance bulletin on July 1st, reminding consumer reporting agencies and furnishers of their critical obligations to accurately report rental and eviction information. We also recently launched a renter assistance finder tool on our coronavirus and housing assistance website to help renters and landlords find relief. The sooner renters and landlords can find financial relief, the better the chances of tenants staying in their homes after the CDC's eviction moratorium ends. We know that more needs to be done. Throughout the pandemic, and even during this recovery stage, we have received tens of thousands of complaints each month. In the 12 months preceding March 2020, we averaged slightly over 24,000 complaints a month. Recently, the average has been more than 75,000 consumer complaints a month, a testament to the continuing struggles of consumers and their families. We are continuing to monitor and review these complaints to understand the problems and issues faced by consumers, because we want to know what we can do to help consumers thrive in the post-pandemic economy. When we begin today's COVID-19 discussion, we will continue to discuss the evolving economic and market effects of the pandemic. We'll explore what the data can tell us about the current financial shape of consumers and families, and how we can continue to help them transition into the new economy and benefit from the national recovery. The second item on our agenda connects to my other main priority, racial and socioeconomic equity. The pandemic has highlighted the many unique struggles facing communities of color and historically underserved communities. Today, we will focus on the racial and economic disparities in the mortgage market that we have identified through HMDA data. While HMDA data alone cannot lead us to definitive conclusions, it can help us to ask the right questions and identify the most relevant problems. We know mortgage applications and originations grew substantially in 2020 because of the refinancing boom and a pickup in home buying in the second half of the year. On the refinancing boom, all racial groups saw increases, even though as a proportion of the population, the share of refinances for Black and Hispanic homeowners declined. In other areas, we also continued to see a lack of significant improvement. Just as a few examples, Black and Hispanic mortgage applicants continue to be denied at higher rates than white applicants. Black and Hispanic borrowers continue to pay higher interest rates than white borrowers. And overall, Black and Hispanic applicants and borrowers continued to have lower median credit scores and lower median loan amounts compared to white applicants and borrowers. Homeownership is important to the growth of sustained family wealth, and we need to determine how we can begin to significantly move the needle on home purchases by minority and lower socioeconomic individuals and families. Also, how do we ensure minority loan applicants pay interest rates akin to those enjoyed by similarly situated white applicants, or for that matter, even be able to receive financing in the first place? I look forward to hearing what you think the HMDA data can tell us about how we could support the growth of minority wealth and increase racial and socioeconomic equity. For our last session today, we will discuss the importance of research partnerships. Research plays an important role in economic analysis and evidence-based policy and rulemaking. The CFPB is responsible for designing, implementing, and enforcing rules that touch on millions of people's financial lives, from applying for credit cards to purchasing a home. We could not do our work effectively without some of the nation's best economic and financial researchers. We also understand the importance of utilizing diverse methods and viewpoints, so we strive to find and maintain strong research partnerships. Research partnerships help to incorporate distinct and unique perspectives and to avoid research and policy silos. Our research partnerships assist us in almost every aspect of our work. First, in rulemaking, they ensure transparency, increase public and industry confidence in the final rules, and often lead to insights for future research and rulemaking. Second, they help us to determine the effectiveness of newly implemented rules through the process of assessments, which the Dodd-Frank Act requires for significant rules or orders no later than 5 years after they begin. Third, through advisory boards such as this one. They advise the CFPB on our research agenda, data collection strategies, and methods of analysis, as well as provide peer review for some key research. We are also interested in research conducted outside of the CFPB that is relevant to the policy questions we face. I hope that during our discussion today, we can talk about important research questions, as well as some of the ways to increase the number of research partnerships and strengthen the partnerships we already have. On our important topics today, your feedback and insight will help us protect consumers in the financial marketplace by informing our enforcement, supervision, education, and rulemaking work. I want to thank you for continuing your work during this pandemic. We all took on so many more familial and community responsibilities during these challenging times, and your commitment is especially appreciated. We've had to constantly pivot as the effects of the pandemic have altered financial markets and communities, and we will continue pivoting as we move through this recovery and hopefully the tail end of the pandemic. I know you all can continue to adjust, and I am grateful consumers have you in their corner. I also want to acknowledge that unfortunately, I need to leave today's meeting at 1:30 for some previously scheduled commitments. I want to assure you that members of my staff will remain throughout today's sessions and let me know of key takeaways and action items. I'd like to end by updating everyone across the advisory committees themselves. We continue to review applications and will make decisions in the near future. A number of outstanding individuals applied, so thank you for helping to spread the word, for your service to the public, and for being here today. Thanks a lot.
Thank you, Acting Director. Now I'd like to pass the baton to the ARC Chair, Mr. Josh Wright.
Thanks, Manny, and thank you, Acting Director Weggio. It is a pleasure to be with you today, and I'd like to echo the Acting Director and Manny's opening comments and welcome all of you to today's meeting. I especially want to thank the Acting Director, as you can see from the opening remarks, for making interaction with the academic community such a priority in helping the CFPB achieve its objectives. It's been a wonderful opportunity to serve on the ARC, and the openness and interactions with the agency and the academic community have been excellent, and we look forward to continuing to work with you in that respect. As Manny mentioned, we're joined by members of the Bureau's Academic Research Council, or ARC. I'm the chair of that committee, but I'm also joined today with the other members of our committee: Terry Friedline, Vicki Bogan, Mike Staton, Tom Miller, and Anthony Yeaser. Michael Bay is absent today, but is an important member of our committee as well, and I wanted to recognize each of them for their contributions to the ARC. I'd also like to acknowledge Jason Brown, Assistant Director of the Office of Research, who's joining us today and has been key, integral really, in the interactions between the ARC and the agency, and it's been a pleasure to work with, so thank you, Jason. The ARC advises the Bureau on its strategic research planning process and research agenda. Members also provide the Bureau, particularly the Office of Research, with technical advice and feedback on research methods, data collection strategies, analytical methods, and including methodologies and strategies for quantifying the cost and benefits of particular regulatory actions. Today is an opportunity for members and the public to hear about the Bureau's research work related to COVID-19, HMDA data, understanding racial and economic disparities in the mortgage market, and research partnerships. With that, let's shift to our first agenda item, COVID-19. We're joined by the Bureau subject matter experts from the Office of Research. They include Eric Durbin and Ryan Sandler. Eric and Ryan?
Thanks very much, Josh, and thanks to the ARC members for joining us today. We're really excited for the discussion today. My name's Eric Durbin. I'm a section chief, one of the section chiefs in the Office of Research. Ryan Sandler really is the subject matter expert here today, and he'll be talking about some of the work that he's done. I'll just say real quick, the Office of Research's work has generally focused on what I describe as persistent phenomenon. So phenomena. Usually we're looking at particular credit markets, how consumers use those credit markets, how consumers make decisions about saving, about borrowing, that sort of thing. The acting director mentioned the notion that the Bureau's had to pivot quite a bit in reaction to COVID, and for the Office of Research, one of the ways that we had to pivot was in trying to look at real-time developments in the economy. It became clear early on that it was going to be really important for leadership to understand as much as possible about how the economy was evolving, how consumer credit was evolving in response to the pandemic. And so we're going to present relatively briefly some of the things we've been finding about how consumer credit has evolved during the pandemic, and then really looking forward to your thoughts about what other things we should be looking at, what do you think we should be looking for in the future, and how research should react to the ongoing economic situation. So I'll turn it over to Ryan to go through the deck.
Sure. Thanks, Eric, and thanks to Josh and the committee. So back in April of 2020, we started trying to figure out what we could get out of the Bureau's Consumer Credit Panel that could tell us about what's happening in the economy, or at least in credit markets. And at the time, my colleagues, Scott Fulford, Evan Najipal, and Krista Gibbs put out a report on inquiries, which show up very quickly in credit record data. And we started setting up code that could look at other credit outcomes, even though we didn't even have the data yet. So if you're not, to remind you, the Consumer Credit Panel is a 1 in 48 sample of de-identified credit records from one of the 3 nationwide consumer reporting agencies. We get updates of the data monthly. Usually we get data from the end of the month as of the middle of the next month. Though in practice, that end of the month data mostly tells us about the month before that, but still even a month and a half delay is pretty fast when it comes to economic data. Last August, we put out a report summarizing the early effects of the pandemic on consumer credit outcomes, which if you were here for the ARC meeting last September, Judy Ricks and I, who wrote the report, presented on some of that. We've continued following these outcomes through April and May of this year. And what kind of the striking thing we've been finding is not a lot has changed. So early in the pandemic, as this graph shows, this is showing the share of open auto loan, personal mortgage, student loan, and credit card accounts that transitioned from being current the prior month to delinquent in the current month. That's the green line, or transition from being, say, 30 days delinquent to 60 days delinquent from one month to the next. And one thing that's clear is that these new delinquencies declined in the early months of the pandemic, and they were mostly either flat or increasing through 2019. And then after about June of last year, which coincidentally is when our report came out, for auto loans and mortgages, delinquencies did start climbing back up, but they never actually really got above pre-pandemic levels. And then starting early this year, then new delinquencies fell again. And part of that, of course, is going to be the stimulus checks that went out in January and February of this year. So we can go to the next slide. Part of the story here, of course, is assistance is being offered to consumers through the CARES Act and related programs. So the CARES Act required that all federal student loans were automatically put into payment suspension, which of course is why there was that precipitous drop off in new delinquencies in student loans, and that mortgages, anyone with a federally backed mortgage who asked for forbearance, servicers were required to give it if the consumer attested that they had COVID-related financial distress. So of course, we see an increase in the overall number of consumers getting assistance in the blue line here for all of these types of loans. But then after about May or June of 2020, the share of loans getting assistance declined. And for auto loans and credit cards where they didn't have the CARES Act support, it's down pretty much to the level of the sort of pre-pandemic levels, despite the fact that we're not seeing increases in delinquencies yet. We can go on to the next slide. The other thing that we've been finding is that there's not, and not just us, so a number of places have been finding that we're not seeing people turn to credit cards to support their spending. The spending in general seems to be down. So all the graphs I'm showing here in this presentation are featured in a series of blog posts that have been going up on consumerfinance.gov, updating results from the August 2020 report up to whatever date was most recent when we ran the blogs. And in the post on credit utilization, we show that credit card balances are down, credit card utilization rates, the share balances as a share of limits are down. And interestingly, even the share of people who are borrowing from month to month is down. So this graph is not actually from the Consumer Credit Panel. It's from another data set, the Y14M, or sometimes we call it the credit card database. Y14M is a collection that the Federal Reserve does from large credit card issuers, represents about 30% of outstanding credit card balances. And this graph, the blue line shows the share of accounts where the consumer is borrowing month to month. You can observe in the Y14 whether or not the account was paid in full each month, something we can't do in the CCP. And the share of accounts that were revolving, that were borrowing from month to month, fell early in the pandemic, and it hasn't recovered. Most of this seems to be going to inactive status, so accounts where they're not putting any balance on, as opposed to them still using the cards but paying it off each month. Although that has also increased. The share of transactors, as we call them, accounts where there's a balance, but the balance is paid off every month. So if we can go to the next slide, the one glimmer of a clear negative result in the credit record data is in credit limits. We do see for credit card accounts that, so this is showing the cumulative change in existing credit card limits. So not counting any changes in a consumer's overall credit limits because of accounts that closed or new accounts that opened, just limit changes on existing accounts. So in normal times during 2019, on average, most in every credit score group, people's limits on average increase, just how credit cards work, how the credit card market works. But starting in March of 2020, limit increases for the higher credit score groups stalled, and for super prime accounts, they actually fell. And this is something that we saw in the Great Recession too, a precautionary reduction in revolving credit by credit card issuers. So taking primarily inactive accounts and reducing their limits or closing accounts in advance of a consumer getting in trouble and running up their credit card balance. But aside from the super prime group, we're not seeing large declines in limits. And then also starting in the last 9 months or so, limits are now increasing again. So we can go to the next slide. The one other thing that we look at in the blog series, this is actually an advanced look. The blog that includes this graph will come out in about 2 weeks. This is not something we did in the August report either. This is looking at access to new credit. So it's the share of of inquiries, not just credit card, auto loan, mortgage, and credit card inquiries. This is when you apply for credit and the creditor does a hard pull of your credit record. We see that. And we can see whether then an account opens shortly after you made the inquiry. So we see, and these were mostly flat or increasing in 2019. But in March and April of 2020, we do see a short-term decline in auto loans, but then inquiry success rates go up, and now they're higher than they were pre-pandemic. The same is true of mortgages. There was a general upward trend pre-pandemic, and it's just kind of increased since then. We do see one spot of concern in credit cards, where there's a decline in credit card success rates early in the pandemic. Some of that has recovered, but it's not recovered all the way. Which does, one thing this does suggest is that there's a lot less, just as there's been less credit card use, there's also a lot less credit card credit out there. Part of it is the reduction in limits that I showed before, but also in Ava, Scott, and Krista's work, they showed there was a large reduction in credit card inquiries. The number of applications for new credit cards was down, and the share of inquiries of new credit card applications that were successful is down, and limits are down. So there's less credit card credit out there than there was before. So there's a little bit of a puzzle of why we're not seeing major negative credit outcomes. To some extent, it's more comprehensible now that the economy seems to be doing better. But we didn't see much happening when the economy was not so good. So if we'll go to the next slide, we can sort of move to the Q&A, start with our first discussion question. So I'll just read this out, and then we can start taking questions. So credit record data hasn't shown much of a negative effect of the pandemic on consumer credit outcomes. At least part of the story is that economic stimulus and payment assistance have kept consumers afloat. And so our questions for you, what areas of financial distress are being missed by the data available to the Bureau? So I told you about our Y14M data, which is administrative data from creditors. We, of course, have our consumer credit panel, which is credit reporting data. But are there data sets the Bureau and the Office of Research should be pursuing to better measure the full picture of financial distress? And yeah, there's a follow-up question, but why don't we start with that?
Mike Staton and Terry, I see you in the queue there. And just a reminder to the ARC members, I'll try to manage the queue, and if I miss you, please jump in. But Mike, why don't we start with you?
Okay, well, I was pondering the question. I'm not sure, unless I'm missing something, I'm not sure that that there's much of an explanation for lack of distress, other than the fact that it's just simply not being reported, or hasn't been reported on a consistent basis for months and months. I mean, there's certainly some other kinds of measures you could look at that aren't credit bureau data, like, you know, eviction, tracking eviction notices and things of that sort. But I would think that if that, I mean, it's kind of a question of what you want to know. I mean, I think we've just got, you happen to have a database here that is, for very good reasons, masking most of the distress signals that we normally become accustomed to looking at. And so that's just my first thought.
That is a very good point. And Mike, if you have any notions of where we would get that kind of data, or who if anyone tracks that is things we would be very interested in.
Terry, I had you in the queue. Do you have a question? Oh, there you are. Go ahead.
Yes. So thank you for your presentation and for sharing these data with us. And I, similarly to what Michael just shared, one of the things that stands out to me is what data are being, the question of what data are being missed and where can you capture it. I think probably, like many of us who are pivoting over the course of the pandemic to conduct research in ways that we didn't anticipate, I ended up, and my colleagues and I ended up switching to doing some qualitative work on how people were experiencing debt, access to credit, and finding, how they described, really important effects on their health and mental health. And I think Dr. Vicky Bogan had given a presentation maybe a few months ago on looking at the, some effects on health. And if there's opportunity to pull in data, that's a little bit more qualitative in nature, that might help to pinpoint where different areas of distress are being experienced, and then what other perhaps quantitative data sets might allow you to capture those experiences in different ways.
That's also a really excellent point. I would be remiss if with that prompt I didn't talk up my colleague Scott Fulford's excellent and now sprawling project with the Making Ends Meet survey, which is a survey, as you may all recall, I think we've talked about it in previous ARC meetings, a survey that's linked to the Consumer Credit Panel, but because it's a survey, we can ask about these things. And I do recall a pre-planned wave of Making Ends Meet went out in May of 2020. And I think even there found that at least consumers who were having financial distress pre-pandemic also were actually better off early in the pandemic than they were pre-pandemic. But there's another wave of Making Ends Meet that went out earlier this year, and they're just getting data back. And I think that's when we're going to get a better look at that kind of information about what's actually happening to people by asking the people.
Tony, I had you in the queue up next.
Okay, 2 points. Number one, you got to be careful about confusing the solution with the problem. If I'm very optimistic about my future earning potential, it's likely I may finance consumption with debt. If I become less optimistic, then probably I'm going to want to carry less debt. So one of the reasons that we see contractions in borrowing is that people are less optimistic about their income increasing. Of course, another fact is by regulation, you're almost prohibited from consuming, right? And it is cheaper to feed yourself at home than it is in a restaurant. So what we see here may be the solution. And the solution is motivated by a change in perspective as to what's going to happen to your future income. Okay, so that's the first thing I say. So I think when you talk about these numbers, you have to be careful about that. The second thing I would mention is that you had some idea about having a financial stress index at a previous meeting we discussed, and I'd urge you to continue to pursue that. I can convey some ideas. The key, I think, is that just as we now have multidimensional poverty measures, having a multidimensional credit stress measure would really help you. And in that case, of course, I mean, part of the real problem is that credit stress is partly based on your ability to service your debt. But having a credit stress index, I think, would be basically a swell idea. And just looking at these numbers by themselves, you have an issue of constructing consumer credit could be the solution rather than the problem.
Those are all really good points. I know that I am not the one who should be talking about the credit index since I've gone to some of the internal talks but have not done any work on it. I believe a lot of the measures that go into the index, at least that currently are going into the index, are similar to the ones we're measuring here. So it might actually measure the index that we are currently working on may actually show similar kinds of trends. But I don't actually know what I'm talking about and should probably pose that question to the team that's working on that index.
Vicky, I've got you next in the queue.
Thanks, Josh. I actually wanted to circle back to a comment that Terry had made previously when we're talking about what are the things that might be useful to look at. And, you know, at the core, the pandemic has been a health crisis. And a lot of my research looks at the relationship between sort of health expenses, medical expenses, and financial distress. And as we think about, even if we get over COVID, you know, there's long COVID. And some of my research indicates that, you know, between 1 and, you know, some studies say 1 in 3 people have long COVID, other studies say 1 in 20 people or 1 in 5 people. But there may be some long kind of term health effects of COVID that could have significant impacts on people's household finances. And we know, so I was wondering if you had thought about or looked at, I know the Consumer Credit Panel had sort of medical and non-medical collections at one point. If you had looked at those types of expenses and their connection, and if those had changed at all over time, that might be something that would be, I would think would be important to look at, right? Because the health crisis, you have the medical bills, but you can also have influence on loss of job or loss of your ability to work because this medical effects are more long-term. The other thing that I was wondering about, if you had thought about at all, is, you know, you talked about in your presentation how people are using credit cards less. But that's in conjunction with a lot of forms of economic assistance. And as those things sort of roll off, it would be interesting to understand if people sort of go back to credit cards more to help them, you know, as the economic assistance tapers off, if they're going to go, you know, if there could be a bump because people are using those to kind of bridge the financial cliff that they might have as, you know, the student loan assistance or the rental assistance or the mortgage assistance tapers down. And so it might be, you know, while we are seeing a trend now, it's not clear to me that that will stay static as the programs start to taper off. So I think it would be important to think about how consumers are affected when the assistance starts to taper down, and they might go back to the credit cards in a big way.
Yeah, as far as the credit cards, you're anticipating the next discussion question, so I'll defer that thought for a moment. Okay. About medical collections in the CCP, that is a really interesting idea. That we have not pursued that currently. I think whether that would necessarily start showing up yet. There's just when I'm not doing the COVID tracking, I spent a decent amount of time doing supporting our debt collection rulemaking. So I've done some stuff with the collections records in the CCP. I'm not sure how long it is between when you would have the debt overdue, have it sent to a collector, and have it furnished, and whether we'd see much of that yet. We certainly might from early in the pandemic, but probably wouldn't have the full picture yet. Part of the reason we didn't do the access to new credit piece in the August report is that there's actually a pretty long lag between when an account is opened and when it shows up on the credit report reliably. And so as of August of last year, we only had like new accounts through like March of last year. So this year we're able to start looking at that. I imagine there's a similar kind of lag with collections trade lines, but I don't know that for sure. And that would be a really interesting thing to look at. Thanks for the suggestion.
Thanks.
Tom Miller, I've got you next in the queue.
Yes, thank you. Thank you for your presentation, and thank you for your other comments by our other ARC members. I'm just curious, actually, it seems to me like the products that you've examined seem to be used more by prime borrowers than non-subprime borrowers. And I'm wondering if perhaps you ought to take another look and look at how credit usage varies by credit score buckets, different sizes or different classifications of credit score, and also look at products that are used by subprime borrowers like cash installment loans from non-bank suppliers like finance companies.
Thanks, Tom. In terms of credit score buckets, all the trends that I showed in this talk or in the deck, we do have versions where we've broken it out by credit score bucket. We've also broken things out by a number of other characteristics, including age, census tract, demographics, changes in the county unemployment rates, how badly were the unemployment rate hit by COVID, number of COVID cases. Everything is the same. All the breakouts by group are boring because they all show, like, they have differences in levels in ways you'd expect, right? Like high income areas have lower delinquency rates than low income areas. Nothing terribly surprising there, but the trend is exactly the same across groups. The one graph I showed that broke out limit changes by credit score group, that's the rare case where there's something different for one group than another, which has also been one of the surprising things we've been finding in the data, that there's so little variation across groups. I mean, admittedly, we have very little in the way of individual demographics besides credit score and age. So it's possible we're missing something because we're not going by the, like when we, like for a race breakdown, we're going by the racial makeup of their census tract, not the race of the individual, which is one really great thing that the Making Ends Meet survey is able to get, is they actually have race because it's self-reported on the survey. In terms of other types of credit, part of the reason we were getting at these types is that they're big, right? They're the big credit markets. We don't have a lot of we probably do have some installment loans. From personal, whether we can break out personal finance companies is more of a big question in the CCP. It's not, I seem to remember there was a project to try to get the credit bureau to identify for us which were like the lending tree, not lending tree, I'm thinking of the wrong company, like the Prospers of the world, and that never went anywhere. So it's not as possible to identify as we might like.
Mike Staton?
So I want to follow up on Tom's comment there. I mean, and first, preface it by saying, I think we're in a weird period here where, this whole thing may become a moot point in another 6 or 8 months. We don't really know when the emergency is going to end. But this period of flying blind is not going to last forever. And pretty soon we're going to be flooded with signals that tell us exactly how much stress households are in. But for the moment, I think when we're in a period, this is a very unusual period, but for something like this, I think intuition kind of tells us, maybe put yourself in the position of the households who've experienced income interruptions, because frankly, that's where most of the economic distress is coming from across the country. It's people who were thrown out of work, in the retail or hospitality sectors or wherever. That's where the bulk of the disturbance has been. So what have they been doing all of this time? And sort of go through that thought experiment. They've had suspension or relief from making either mortgage or rental payments now for a while, or receiving some sort of assistance, and that's freed whatever income they've had to devote to other areas. Probably still having to struggle to make ends meet. Don't know whether the stimulus checks have helped and to what degree. Don't know whether some of that employment has come back. But, to the extent that you can track those sorts of things, that may give you some clue as to where continued stress happens to be. And the use of these alternative financial products, as Tom suggested, payday loans and things like that. That if there's been a blip in those sorts of things, that may be another signal too. But it's almost, I just have a feeling that by the time you figure out what good measures to use, you won't need them anymore, except maybe for the next crisis.
That's a really good point. A lot of the alternative finance sources just aren't in the consumer credit panel because it's credit bureau data. It is what it is. Some of that I know the Making Ends Meet survey has gotten at. I know there's questions about payday loans. I think the use of that was down in the May survey, but I might be making that up. We have there's a report out about the May wave of the survey that was from early in the pandemic. There's a report, I think, going to come out in the next 6 to 8 months from the most recent wave of the survey. So I think we've we, and by we I mean the Office of Research, not me because I'm not on that project, have just gotten the data in and ready to use from that third wave that went out in the middle of the pandemic and had directly pandemic related questions. That'll be really interesting to see once we get that.
Just on payday loans in particular, the Making Ends Meet survey does ask about use of payday loans, use of auto title loans, use of pawn borrowing, pawn shop loans. But the sample size is much smaller than for the CCP, right? So, and those are products that are used by a pretty small fraction of the population. So from the May survey, we did see, I think, a decline, something of a decline in use of payday loans and those other types of loans, and a fair amount of persistence in the folks who used it pre-pandemic and during the pandemic. But again, the sample size is relatively small, so that is a challenge with the survey. That the great thing about the CCP is just is the sample size lets you look at things, but a downside is it only reports on types of credit that are furnished to credit bureaus.
Terry has a really good point in the chat, saying that maybe one task is to think and plan strategically on what data sets we will need for the next crisis to have more real-time understandings from the depths of people's financial distress, which is a really good point. Although I believe, and I may be making this up, but I think I read about this, that part of the motivation in developing, oh no, it wasn't the consumer credit panel, this is a different data set. All right, but part of the reason in developing some of the data sets we have, I think not so much, partly the consumer credit panel, but also the National Mortgage Database, was specifically responding to what data sets we would have needed to track the last crisis. But of course, the last crisis was very much a credit crisis, and the crisis was seen in credit card debt and mortgage debt. Always the challenge that you're getting ready to fight the last war.
Ryan, I don't have anyone else in the queue for that question. So do you want to segue, transition over to the next discussion questions? Maybe set them up a little bit.
Sure. So this is related to. Oh yeah, there was a second sub question that I don't know that we entirely touched on, but so we talked about what we're missing in the data. The other question is that obviously a huge part of the story here is the economic assistance that's been offered, between stimulus checks, between extended unemployment insurance, the CARES Act forbearances for mortgage and student loans. I mean, it'll probably be some time before we have data, if ever, that we can tell a causal story, but I find it hard to believe that the credit picture would look quite so rosy without those things. And so my question for you all is, what should we be watching for as these programs end? Currently, I think the student loan program was just extended. It's hard to know what's going to happen with the CARES Act, but likely sometime in the near future, the support for mortgages, support for student loans are going to end. I think the unemployment insurance mostly has ended. What should we be watching for as all these factors roll off?
Go ahead, Tony.
Okay, well, two reactions. First, everybody's going to be working on that. There's going to be so much research on this topic. It's pretty much going to be unbelievable. And a second observation is what happens is going to depend upon what's going on in your housing market, right? I mean, we have markets where house prices in a year rose 24%. I think those mortgages are going to be pretty solid, even if after this the moratorium ends, there has to be a sale of the property. I think the borrowers are going to do pretty well. On the other hand, you know, if the if house prices rose 3%, then it's a different story. So it's going to be a fairly nuanced sort of an inference. Finally, one last point of general opinion, but something that actually the CFPB really ought to worry about, and that is right now, payment option mortgages aren't even legal, and yet the government periodically mandates that the payment on a mortgage be optional. So this is basically completely nuts as public policy, right? I mean, if you're going to say that you can't contract the terms under which payments can be optional, but every once in a while the government is just going to say, oh, okay, payments are optional, independent of any contract. You know, that's about as completely contradictory as public policy could be. So it might be that the CFPB ought to look into that and suggest that maybe we ought to allow for mortgage contracts to actually have some payment option provisions in them that would perhaps regularize what's going on. That is, if we care about rationality at all.
Any other questions from the ARC team on this sort of second sub question? Why don't we roll to the third then, Ryan?
Sounds good. Okay, so this gets back to a point that Vicky was making earlier. At least during the pandemic, credit card utilization and usage patterns seem to have changed. There's the graph that I showed on the share of consumers that were revolving versus transacting on their cards. That's changed. Utilization percentages are down, which is a little surprising in as much as our colleague Scott Fulford has a paper showing that during the Great Recession, even during the Great Recession, when there was huge changes in credit limits going around, utilization rates were remarkably stable. But utilization rates are actually down during the pandemic. Of course, balances are down, which is partly because spending is down, which is partly because there's less sorry, I got distracted by something, which is partly because there's less to spend on and partly because of the assistance like someone mentioned. So do you think that these patterns are going to revert as the economy recovers to the sort of pre-pandemic norm? And what factors do you think we should be monitoring in this market?
Let's start with you, Tom.
Okay, thanks. You know, I think I'd just like to go back and reiterate a bit what Tony said, in that, you know, if people are forecasting their own incomes, their own financial situation, you might not see any big change unless there's a change in the expectations of the families. If things are going to get worse, you'll see less credit. If things are predicted to get better by each family unit, you perhaps will see more credit usage. So I do think that Tony has a really good point about each person's or each family unit's forecast of their financial well-being will be a big driver of what we see.
Terry?
I think I would expect patterns to return, and the inequalities that that we've seen across kind of income and race, that those would expand as the economy will not recover, that people will not experience the economic recovery equally. Employment rate for Black and Brown Americans will continue to be twice as high than that of white Americans, and that some of that will be, I think, reflected in credit card utilization. So I would pay attention to the extent to which our inequalities, the inequalities that existed pre-pandemic grow after it's determined when the economy is at a point of kind of on average recovery.
Michael Staton? Mike, you there?
My mistake.
No worries.
I was just going to echo Terry's comments there. I think we've seen too many credit cycles in the past where, as we were coming out, there was questions, have consumers finally gotten religion with respect to borrowing? Is there going to be a sea change in attitudes? Are they going to be more conservative going forward? I don't see any reason to expect that this time through. I think, the patterns that we've witnessed in the past that have driven credit utilization on credit cards and frankly, credit card usage have been more reflective of rising incomes, broader access to credit cards, writ large over the last 30 years, and the emergence of some alternative payment systems too that have maybe tamped down what we might have expected with credit card usage otherwise. But I don't see any of that having changed through the pandemic. I think we'll probably return fairly quickly as the economy recovers, let's put it that way, and employment recovers. I think we'll return to past spending patterns. The people with higher credit scores and or higher incomes are going to have more things to spend money on than they have in the past, and we're going to see that reflected in credit card charges, and just like we have in the past. So there's nothing structural to me in what's just happened over the last 18 months that suggests that those trends would be different once we've returned to normal economic activity.
That's a really good point, Michael. Although the thing that has sort of been percolating in my mind as I've been thinking about this is that employment has started to recover and GDP has started to recover over the last, 12 months or so. But credit cards, both credit card usage and credit card utilization rates have not. So they've continued that downward trend. And admittedly, the demand opportunity, it's not clear how much that's recovered. I mean, I guess GDP is going up, so someone's spending money somewhere. Yeah, and so it's a question of, at some point, we ought to start seeing this come up if it's reverting, but when do we expect to see that happen?
Yeah, that's a great question. And I think, international travel is still pretty much prohibited for most people. And so, we don't have that spending category any longer. Hotels and restaurants have come back, certainly, but still not quite to where it was. That spending opportunity is still at bay. And so I think we just need to watch for all of the other signals that we're looking at in terms of not lockdowns that we're experiencing, but pullback in terms of what's open, whether there are capacity restrictions. When those start to come off, I think you're going to see it snap back pretty quickly.
Terry?
I just wondered, one of the slides that you had shared with us was on credit limits on credit cards that were cut or frozen, and seeing a drop of particularly the super prime and also like near prime credit score, folks with credit scores. And I just wondered if you had a sense of, what to make of that, and if that relates kind of to this question about utilization and usage patterns. I had some thoughts, but I wonder if that's part of the story and if you've spent time thinking on it.
Spent a little time thinking on it. I think it's all part and parcel of sort of preemptive credit revocation by the credit card issuers, some of which we saw in the Great Recession as well, where that sort of to prevent people who have good credit and aren't using their cards from running up balances on their cards, they cut limits or close the card. And we did, there's a graph that's in the, both in the blog post and back in the August report, showing the share of credit card accounts that were closed in each month. And indeed, I think it was April of 2020, there's a big spike in account closures, but it was just then. So it's like they cleaned out a bunch of inactive accounts, and then they were good. And then the closure rate sort of dropped back to pre-pandemic normal levels, which is sort of another factor that's leading to the overall amount of credit card credit out there declining, because closures, even though they're not at an elevated level, the closures are at a normal level, acceptances are at a lower level, inquiries are at a lower level. And so the overall limit out there must be going down.
Thanks for that. I wasn't sure if I was reading this correctly, because what it was making me think of was with those with the lowest credit scores, also maybe having the lowest incomes, were having limits on their credit cards, maybe possibly raised or extended, which would mean, indebtedness, opportunity for more indebtedness and financial distress at the end, but perhaps not. But thanks for explaining that.
Michael?
So, Ryan, one of the things I just remembered, you asked the question, when might we expect a sort of return to normalcy and to check and see if spending would come back. There's been a really interesting index that I started following about 4 or 5 months ago that Goldman Sachs put out. It's the Europe Reopening Index. I don't know if you're familiar with that, but they've managed to put together a variety of different data sources, things like tracking airline website visits and bookings on airlines and numbers of restaurants that are open. And they're doing it basically as an international index. They haven't put the US into that format. But to see how the relative rates at which Ireland or France or Great Britain or whatever were returning to normal. And there might be some clues if you're really casting about for data. And again, keeping in mind that maybe this is all going to be over in 6 or 8 months, who knows? But for the next crisis, if you're casting about for data, I'd look at some of those sorts of sources, because it's pretty darn interesting in terms of granular measures of activity that would be a significant predictor or indicator, real-time indicator of how people are feeling with respect to spending. And so I'll just throw that out there.
Ryan, I think you have. I think you can declare victory. You've exhausted the queue of questions, and I've been granted permission. I think we're a couple minutes ahead of break time. But if you want to close with any closing thoughts you have or whatnot, we can close there and take our break to come back for 2:30 for the next panel. So anything you want to close up with, Ryan?
Not from me, except to thank you all for your thoughts and input. I'll defer to Eric if Eric's got any closing thoughts.
I'll just say thank you as well. I think we've gotten some really interesting and good ideas from this, and I just, based on Michael's comment right there, I was thinking if we had a state level reopening index, that would be a great tool for some interesting analysis. Maybe even after we come out of all of this, to understand what the different factors were going into this. In any case, thanks everybody so much for their thoughts and time. This has been really interesting for us.
Thank you so much, Eric and Ryan. And we will take a break and come back we'll reconvene at 2:30 for the discussion on the HMDA data, understanding racial and economic disparities in the mortgage market. So we will see you at 2:30. Thank you. Okay, welcome back everyone from our break. It is time for the next session, and we'll shift to the next agenda item, which is HMDA data, understanding racial and economic disparities in the mortgage market. We're joined by Feng Liu, senior economist from the Office of Research, to present. Feng, are you there?
Yep, I'm here. Okay, so thanks, Josh. Yep, can hear. Can we move on there? So standard disclaimer point. So any opinion and views stated by me in this presenter on my presenter's own and may not represent the Bureau skills. So with that, let me start with the presentation. Let's go to the start. So what is a HMDA? HMDA is a data collection, reporting, and disclosure statute that was enacted in 1975. The HMDA data are used for three purposes. One is to determine whether financial institutions are serving the housing needs of their local community. Two is to facilitate public entities' distribution of funds to local community to attract private investment. Three is to help identify possible discriminatory lending patterns. Financial institutions covered by HMDA are required to annually collect and report specific information on each mortgage application acted upon and purchased during the prior calendar year. Next, please. The 2020 HMDA data collected in 2000 and reported in 2021 are the third year of data that incorporated the change made to the HMDA by the Dodd-Frank Act and the 2015 HMDA review by the CFPB. HMDA data would provide good insight on the racial and economic disparity in the mortgage market. That's one of its purposes. But it's important to emphasize that the HMDA data alone cannot determine whether a financial institution is engaged in discriminatory lending. For that, in many of the CFPB supervisory and enforcement work, often would require additional data and additional information to make a further determination. Next, please. Based on the recent HMDA data, we have published a series of reports. One of the reports forthcoming in this probably next week is about the 2020 mortgage market activity and trends. Some of the information I'm going to present today is taken from that report. In July 2020, we have another report based on 2020 HMDA data on Asian American and Pacific Islanders in the mortgage market. In June 2021, I have another report about the general lending pattern of small to medium-sized closed-end HMDA reporters. And then similarly, in June 2021, we have a report on the manufactured housing based on the HMDA information. And in each of the past 2 years, we have 2 annual articles about the HMDA. In particular, the very long one, the updated review of new and revised data point in HMDA, published in August 2020. You will see some of the chart taken in from that in today's presentation. So next, please. So today I'm going to try and cover this, several major subjects, subfields we can observe from the HMDA. One is about the racial composition of originated loans. One is about denial rates. And then there's a characteristic of mortgages, including the credit characteristics of mortgage and borrowers and the mortgage pricing. So next, please. On the racial composition, this chart basically shows for the past 3 years the share of home purchase loans by race and ethnicity. Just like what we observed before the 2018 HMDA data, in each of the past 3 years, the share of a minority, typically here it means Hispanic, white, and Black borrowers, the share among the home purchase loan are certainly lower than their share in the overall population. And from year to year, there's also change. And that next chart, this for the refinance loan that shows a similar pattern that Hispanic and Black typically account for the smaller share of a mortgage loan here, the refinance loan compared to population overall. Next, please. But it'd be interesting to see how the trend have changed over time. To set that as for the background, this chart plotted out the monthly origination volume separated by the loan purposes, that home purchase, non-cash out refinance, and cash out refinance in the past 3 years. So let's look at the home purchase loan. That's a green line. And typically, home purchase loan origination will follow a strong seasonal pattern, as the housing market does. But if you look at in 2020, what's one thing in particular is like in April and May of last year, while the housing market typically would have been gearing up to get into a summer house sales season, there was actually a dip in the home purchase loan origination volumes there, contrary to seasonal pattern. And we believe that's the strong signal of what we saw the COVID effect as the nationwide shutdown took place during those 2 months. But the home purchase volume quickly picked up starting in June of last year and then rose, stay at a fairly high level, especially compared to the year before. So that match what we widely heard in the media report about the heating or overheating housing market. But most prominent feature of 2020's housing mortgage market is the refinance boom. Well, by looking at this chart, particularly the non-cash out refinance boom, the refi boom actually did not have a start in 2020. It really started in 2019. Other than a dip in the slight dip in the last quarter of 2019, you can see the refinance boom was very much like a continuation of the trend since 2019. And the cash out refi also increased, but that was really much overshadowed by the non-cash out refi, and reasonably because people are taking advantage of the extremely low interest environment and refinancing into the lower ratings. So that's a background. Now let's look at the next chart and see how this varied by the race and ethnicity. This focuses on the home purchase loan, and a vertical axis shows the monthly origination volume by different race ethnicity. Top line is a white. So you can see that overall, all 4 groups here, the monthly origination volume of home purchase loan actually increased for all 4 major groups here. But because of the white borrowers come for the significant large amount of loans compared to other groups. So in order to see this better visually, let's zoom into the next chart. And so this chart really is the same as the last one, except we dropped the white and rescale on the y-axis, so you can see those 3 minority groups more clearly. And from this, it's clear to see the increase of home purchase loan volume for all 3 minority groups here. And next chart, please, in 2000. So this turn the y-axis now is not instead of volume, it's a share, how much each of the ratio ethnicity group as you count among the total share of home purchase loan. And you can see at the end of the second half of 2021, the relative drop of the share for white and relative increase the share for all 3 minority groups. And we can again advance to the next chart. You will see, just focusing on the all 3 minority group alone, and you can see that increase of the share for all 3 groups in the second half of 2020. Now, let's move on to the refinance loan in the next chart. That's the most prominent part of the 2020 mortgage market. And again, it seems like pretty clear that the increase of the refinance volume, the refinance boom, occur for all the race ethnicity group in the chart. But it appears like the Asian have the most prominent increase. And this is more, you can see this more easily if we zoom to the next chart with all 3 minority group. And you can see the Asian volume increase, all 3 minority groups volume increase, but Asian increase even more than the Black and Hispanic. And next chart will show the share. Similarly, you can see the increase the share of Asian compared to the Black and Hispanic. And that will be more prominent once we zoom into those 3 minority groups in the next chart. So clearly that you see near the end of the 2021, the Asian share among the refinance loan increased from the fairly low level in 2018 to over or around 7% near in the end of the 2020. While the Black and Hispanic, again here the The backdrop is that everyone increased in absolute volume, but the relative share have decreased for the Black and Hispanic. So next, please. Previous chart are all about the originating loans. So this one look at the denial rate. So that is basically at the application level. Sometimes data collected at the application level. This is taken from an AAPI report. So it's been established in the past, and we know that, and this is again confirmed in 2020. Like Black and Hispanic borrowers are more likely to be denied than white and Asian. So in the chart, it shows a Black borrower in application. I would say Black applicants in 2020, about 80% of the complete application were denied, and 12% of Hispanic white application were denied. That compared to 7% denial rate for white and to 8% denial. I would say 10% denial rate for Asian Pacific Islanders. And next chart, the next chart takes this a little further. So it's focusing on the AAPI alone. So in this AAPI report, we show that despite the overall low denial rate, I say 10% for AAPI as a general group, if we look at the disaggregated race ethnicity, which is allowed to be reportable, it becomes reportable in 2018 HAMDA data and beyond, a certain subgroup of AAPI population, such as Vietnamese and say Native Hawaiian, actually have a denial rate closer to or even slightly above that of Hispanics. So Vietnamese denial rate at 13% and Native Hawaiian denial rate at 13%. And let's recall that the denial rate shown in the last chart for Hispanic was about 12%. So that kind of added a little more of the dimension. There's a lot more complexity when we look into the specific of the denial disparities. Next, please. And obviously now those denial outcome and what we show up above as have counted for the specific characteristics of the loan and borrowers. Right? And we know that characteristics of loan and borrowers may vary by race and ethnicity. So this chart shows for the 2020, the median loan amount by different race ethnicity group, separated by home purchase and refi. So green bars are home purchase, refi those dark bars. And it's apparent that Asian buyer took out the largest median loan amount for both the home purchase and refi, while the Black and Hispanic buyers took out the lowest median loan amount for both home purchase and refinance loans. And next chart, please. Credit score is a new data point collected since 2018 HAMDA data. And again, this one shows the Asian buyers have higher median credit score than all other groups for both home purchase and refi, while Black and Hispanic borrowers have the lowest median credit score compared to white and Asian. So next, please. How much do borrowers pay? Right? Well, in terms of interest rate, the overall interest rate in 2020 was significantly lower than previous years, but the variation of interest rate among racial ethnicity group in 2020 still persisted, just as in previous 2 years, which we observed before. Among the home purchase loans, Black and Hispanic borrowers pay the highest median interest rate at about 3.275%, while Asian pay the lowest median interest rate at about 3%. Among the refinance loan, the variation of interest rate is much narrower. Right? Asian pay the lowest interest rate at about 2.875%, while the other groups, the median interest rate are all the same, or at around 3%. And next chart, please. Total loan cost is a new data point in HAMDA since 2018 that basically captures both the originating charge by the lenders as well as the third parties charges that association in obtaining the loan. And this chart shows that, so interestingly, that for both within the home purchase and refinance loans, Black and Hispanic borrowers turn out to be paying the highest median total loan cost compared to the white and Asian. So that is an interesting finding. Next, please. Now, we talk about the credit score, and here's some detail on the credit score distribution, because we all know credit score is important in influencing the underwriting decision, it influences the outcome of the mortgage pricing. And the previous median interest credit score show was about the originating loan. I want to emphasize this chart I show is at the application level. So clearly you can see that the amount of this is histogram. So Asian, Hispanic, Asian and non-Hispanic white bar have a generally higher distribution, higher credit score than the Black and Hispanic white. One thing I do want to point out, and you probably would have noticed that, is that this is application level. So you clearly see there's some heavy bunching at certain credit score levels, like 620 and some other level there. This, from the researcher perspective, is fascinating because that really much means that in the normal credit score distribution of all the consumers should be smooth. But here we see those bunching. So in a way that they're likely heavy screening and pre-screening before those what are people seeking the mortgage actually will eventually even capture into the formal application as reported on the handout. Next chart is very similar. That is for the previous chart is the conventional conforming space, and this chart is for jumbo space and at application level as well, and very much similar. We observe a similar pattern. That's the credit score distribution for the Asian and white are higher than the Black and Hispanic. Next chart, please. So in the interest, I'm just going to skip this and next one quickly. Those are basically the same point. You can see within the government loans, distribution variation of credit score are much narrower than the conventional conforming and jumbo, but still some disparity between the different race ethnic groups still exists. So this for VA, and next one is for, next please, that's for RHS FSA. FHA loan is basically the same, and those are actually including in the 2020 report. Next, please. So, as we showed previously, right, so at application level, right, so people across different race ethnicity groups have different distribution credit score, and credit score itself would have influence credit outcome. But this take it a little further, right? Here, so this is the limit to the conventional conforming 30-year fixed rate mortgage application. So in a way, you control for certain things, and this is being scattered. On the horizontal axis, the credit score. Vertical axis is a denial rate. So basically, show at a distribution at different denial rate bins how much this different credit score being how much the denial rate is, and separated by different race ethnicity. And this chart shows so within this particular type of product, even within the same credit score B, at the same credit score level, we'll see a higher denial rate actually for the Black and Hispanic borrowers applications than the white and Asian. We think this is important in an observation in itself, but also there is a level of complexity whenever we look at a denial decision, and this can be illustrated in the next chart that you will see. So let's move on to the next chart. And just take the last chart a little further. Not like a denial rate, but this basically look at for the given credit score being, what is the CLTV, another new data point in the HMDA, look like across different race ethnicity group. And it clearly shows that, right, so with the same credit score, the Black, even with the same credit score being, the Black and Hispanic borrower also tend to have a higher CLTV. So to what extent this can help to explain the chart we saw above, the before this one, that's even with the same credit score being, the denial rate is higher for Black Hispanic. That is the open question. And this is just as something we introduce to you is like, can use such those information to help us facilitate how much is how to best from researcher perspective, how to draw into such an issue, explain and look at the issue of racial ethnicity to reach a better understanding as the goal of this session. So with that, I'm going to turn this back to Josh for the panel discussion. Thanks.
Thank you, Fang, for that excellent presentation. So ARC members, we are into the Q&A session. If you raise your hand virtually, I will see you and be able to call on you. I think this is there are a lot of potential places to go here, and questions ranging from what we learn from the data, interpreting the data, what we think the CFPB might be able to do to help reduce disparities in the mortgage market, all sorts of specific questions. But let me sort of first start with ARC members and see if you've got any reactions to the presentation or directions you would like to take the discussion. Tony?
I think that the next step in all this, of course, would be a statistical analysis in which you try to estimate models of the underlying decision to price credit, what have you, and then you try to relate all of these factors simultaneously to the final decision, rather than do things one at a time. Plus, even when you do them one at a time, you don't have any statistical significance bounds to let us know things are different. So that would be a first thing. A second thing is that we presumably have programs like FHA, which would have characteristics that we would expect. Well, and let's put it this way: if there's a problem with FHA, then there's a problem with the government, right? So perhaps we ought to take a look at those programs separately and see if they have similar patterns to others, or in fact, if they're totally different. So those would be my two comments. The first is, this is all statistical, and the question is, does anything have statistical significance, especially in a multivariate context? Secondly, break out the government programs, particularly FHA. I think VA is a little different operation, but particularly FHA, and see what it looks like. And a final general comment that I'll make over and over again is that, remember, where you are matters in mortgage lending. And if you're if you're in some area where house prices are rising rapidly, that probably has a negative effect on default, as opposed to areas where house prices are flat or falling. So that location also needs to be considered. So those would be my comments. And basically, most of that is pretty much standard in the literature. So if you look at the academic literature on these topics, I think you'll find that in the literature.
Thanks, Tony. And let me open to other ARC members with general responses, reactions, comments, ideas on follow-up research the CFPB should be doing to address racial and economic disparities in the mortgage market, whether topical ideas, methodological, etc. Terry, let's go to you.
Well, thank you very much for your presentation. Just kind of as a general comment, one of the things that struck me as you were presenting was that our kind of vantage point into some of these disparities in the mortgage market, or disparities in consumer financial distress, or just consumer financial distress, comes from the vantage point of the consumer, which, I mean, makes a lot of sense as, part of the Bureau's kind of charge in protecting consumers. And something that you mentioned about the distributions of credit scores being perhaps representative of not making applications, perhaps having them be stunted at different points in the process, and that these distributions were just one snapshot of the process, process that happens more toward the end, that we often don't have a vantage point into the decision making, within institutions and whether and how institutions are making decisions at particular points along the process that relate to how consumers experience them. The FDIC at various times has conducted surveys about how banks and other financial institutions are serving underbanked and unbanked populations. So they have kind of their running survey on the experiences of households, but from time to time, they've taken those similar questions and looked at institutions themselves and, what are banks doing to serve unbanked populations and how are they responding to this challenge? And it might be helpful, as another source of another vantage point, other sources of information to see, well, what are institutions doing that might have implications for these disparities in housing.
Thanks, Terry. Vicky, you're in the queue.
Thanks, Josh, and thanks for a really interesting presentation. One of the things that I wanted to mention that struck me as I looked through some of the information are the discrepancies with the racial disparities in refinancing rates. And so one of the things that I think would be interesting to look at a little more is a lot of the research in the mortgage market is on kind of the primary market. And we're just starting to see some more interesting research on how there are racial disparities in exploiting lower interest rates and refinancing. And so I think there's quite a bit of opportunity to explore why there's such discrepancies in refinancing. What are the factors that lead to that? And also think about considering policies that help to perhaps reduce barriers to refinancing for minority borrowers. So those are the things that kind of struck me from the data that you presented.
Thanks, Vicky. Feng, I don't know if from those original comments, I've been sort of collecting them for feedback and was going to give you a chance to sort of respond at the end. But if there's any of those you want to expand on, engage with, respond to now, I'm happy to sort of let you do that now, and we can then go back to the queue.
Yeah, thanks, Josh. I have to make an acknowledgement. So for people who do not know, Tony was actually my PhD advisor. And it's very rare for a student to ever have opportunity to thank his advisor in a public meeting like this. So thank you, Tony, for everything you have done for your students and for what you taught us, including today. I learned Hamda first time.
By the way, thank you for being such an excellent student, okay? It was always a pleasure working with you.
Thank you. And I hope that also simplifies right, that shows a synergy between the ARC committee and the CFPB office research, right, in the way that you teach us, we learn, and we learn together, and we work together. So on some of the question you have there and the comment there, I totally agree with a lot of it say there. On the multivariate analysis, definitely it's important because any of the bivariate analysis is just insufficient from the research perspective, right? We're not going to get establish any of its final causality in that way. In fact, the point we made in that chart, like last two charts we showed there, was largely to show you need to have more factor to take into account to basically get to that final explanation or more solid explanation of what we observed in the outcome. On the FHA program, FHA programs are very unique, and here I can show you as one example why by looking at the FHA program alone will be really helpful for some of the observation we show there. For instance, we show the median total loan cost was higher for, say, African American and Hispanic. That itself is striking. But we also know that FHA loans tend to have a higher median total loan cost. And that is mostly due to the fact that upfront insurance premium was required at the closing. So that increased to the extent, say, it's Hispanic and the Black borrowers are more likely to take out FHA loans. So by counting for FHA effect, that could explain some of the observation we have there in terms of total loan cost. I'm not saying that would be totally sufficient to explain all that disparity away. To get that, again, I will get back to your point about my multivariate analysis. And also agree that the literature is standard. So there are a lot of literature, and I know, Tony, you contributed to those in the past, right? And all this started in 1992 from the, right, not 1992 Boston Fed study, right? It's been many, many years. But with that said, there's still certain like econometric challenge there. There's always the issue of omitted variables from the researcher perspective. There's the issue of model specification. There's the issue of a certain factor could be endogenous. Right? Even like we show there at application level, what you saw is as application HMDA are not totally, not really entire credit demand. So there's level of complexity there. Those are the things we really hope that I can get more guidance from you, from your ARC members. And geography certainly, yeah, it's important. And for Terry's point about, say, bank decision, well, right, so to understand the lender decision, absolutely that's important. One thing we have advantage at CFPB is because we also a financial regulator. So we actually have this ability to go to the financial institution to conduct the investigation, well, not the investigation, that is supervision exam. And through the supervision exam, we will have access to typical lenders' policy and practice. So in that way, have a much better understanding of what they do. We can, in our modeling, if we're looking at a particular financial institution, whether they are either denial decision or mortgage pricing, will have a much better ability than general public loan or side to match, to model according to the written policy and guidelines of the institution. So that is one of the advantages we have here. And for Vicky's question about refi, absolutely, that is a very important question. Why do we see like a certain group are less likely to take advantage of lower interest rate? There could be many different barriers, also from research perspective and from policy perspective. There could be hurdles such as because refinancing is not costless. There is a upfront fee that people need to pay. There may be a hurdle there. There may be a matter of financial literacy. There are many other things could be in play there, and that is a very rich field. I think everyone should be explored. Thanks.
Thank you, Feng. And those are great responses. And I think for me, one of my reactions to learning about that data and from others' questions, and in particular Vicky's, is sort of thinking about how to get at some of this geographic variation, whether it's sort of on the mortgage side or also the variation in state and local, other state and local regs that affect some of these outcomes, because it may well be from a policy perspective that one of the key roles for the CFPB is communicating or influencing state and local regulators with its sort of expert input. In any event, let me open. We still have got a little bit of time, a couple minutes, maybe time enough for one or two more comments if any of the ARC members have them. Anybody else in the ARC with a comment they are sitting on or waiting to unleash? If not, we can break a couple of minutes early. We're in fact getting pretty close to the end of the session anyway. So let me just check the queue one more time to make sure I'm not cutting anybody off. Okay. Thank you so much, Feng, for an interesting discussion. We are going to enter our break now, and we will return at 3:30 p.m. Eastern for our discussion on research partnerships. Thank you again, Feng.
Thank you all.
Okay, welcome back, everyone. We're going to shift to our final agenda item today, which is research partnerships. We're joined by Bureau subject matter experts from the Office of Research, including Melissa Knoll and Patrick Heck. Melissa and Patrick?
Thanks, Josh. And thanks, everyone, for sticking around for the last session of the day. As Josh mentioned, my name is Melissa Knoll. I'm the section chief of our Decision Making and Behavioral Studies group, and I'm joined by Patrick Heck, who's a research scientist in our section. Next slide, please. Before I begin, as others have, this presentation is being made by Consumer Financial Protection Bureau representatives on behalf of the Bureau. It does not constitute legal interpretation, guidance, or advice. Any opinions we express are those of Patrick and myself and may not represent the views of the Bureau. So today, as we mentioned, I'm going to be talking about research partnerships. And so we'll be talking about the different types of research partnerships, what partnerships we've engaged in the past and what we're doing now, how we actually get the work done and establish these research partnerships. And then Patrick's going to talk about preliminary results from 2 of our current partners. And so as we're thinking about research partnerships at the Bureau, they loosely fall into 2 buckets, research pilots, which come about either based on Bureau research priorities or just ongoing research ideas that we have over time. There's also innovation policies that drive some of these Bureau partnerships as well, which I'll talk about briefly, though today the main focus is these research pilots in the Office of Research. Slide. Actually, you can go through 2 slides. I'm going to talk mainly about those research pilots. Okay. Oh, no, back one. Thanks. Thank you. Okay, so what are research partnerships at the Bureau? Essentially, these are research projects where we collaborate with innovators to research the impact of financial products and services on consumers, and also to learn more about what is currently happening in the field in people's financial lives. An ideal collaboration, though this is not all of them, involves sophisticated research methodologies that will hopefully allow us to test hypotheses and obtain statistically meaningful results from real-world behavior. And so the goals following that are to understand the impact of products and services on consumer behavior and consumer financial health, also to further the Bureau's initiatives, such as promoting savings, which was a previous priority, as well as studying the effect of COVID-19, protecting vulnerable consumers, or any other research priorities we may wish to engage in. And then, as Acting Director Waigeo mentioned at the beginning of the day today, these also have the potential to inform Bureau's policy work as well as rulemakings, depending on what the topics are and the rigor of the studies. Next slide, please. Great. So there are various partnership types that we've engaged in, or we plan to engage in. Some of these are randomized field studies and experiments. And so if those are aware of our previous studies, there was one with American Express, as well as H&R Block. Those reports can be found on the Bureau's website. There's also a current project underway related to financial education software provider. We've also done experiments and randomized control trials, as well as descriptive studies to help understand Bureau tools and materials. And so there was a Credit Karma study that, among other things, looked at the relationship between financial well-being, using the Bureau's financial well-being scale, and credit scores and other variables, as well as a study with Zillow to help understand consumers' shopping behavior around the home buying and mortgage process, as well as to help us learn more about the Bureau's home shopping tools. And then we also have several data partnerships. One is currently with a community development bank, as well as one with a savings app provider, where we typically get the data in from these companies and we're able to analyze what's actually going on with their customer base. Slide. Great. And so moving on just very briefly to innovation policies at the Bureau. These are housed in the Office of Innovation and come about through an application process where financial institutions and innovators can apply to engage in any one of the following policies or programs. Next slide. So first is a trial disclosure waiver program. And so under Section 1032E of the Dodd-Frank Act, the Bureau has authority to grant waivers that allow in-market testing of innovative disclosures. And so the Bureau can work with innovators to test and improve disclosures for consumers and industry. There's also the Compliance Assistance Sandbox Program, whereby companies can obtain a safe harbor for testing innovative products and services for a limited time while sharing data with the Bureau. And there's also a no action letter program that provides increased regulatory certainty through a statement that the Bureau will not bring supervisory or enforcement action against a company for providing a product or service under certain facts and circumstances. And those who are interested in learning more about these policies, this is on the Bureau's public-facing website under the Office of Innovation. Next slide, please. Great. So why do we engage in these research partnerships? There's several goals. First, of course, we want to understand what is happening in the field, what is happening in the lives of real people in the real world. How do consumers behave? What products and services do they use? Myriad other questions we might be interested in at any given time. We also hope to evaluate financial products, services, and educational materials to learn whether a product or service can actually cause improvement or harm on meaningful consumer outcomes. And so although different types of partnerships vary, as I mentioned in earlier slides, our goal ultimately is to try to seek and encourage partnerships that can generate causal inference. So we do see the value in anything between descriptive findings all the way up to these experimental and rigorous RCT type projects. And so you can imagine maybe why the CFPB is interested in some of these. I mentioned some of these goals. We like to study the effects of innovative practices on consumer outcomes. We also use these research partnerships to learn more about key priority areas. One very important aspect of this is the publication of these findings. So we are always trying to get meaningful evidence-based information out into the policymaking and research world. And so this is one of the main aspects of our research projects. And so again, you can find a number of these previous projects on the website. And also, as I mentioned, hopefully we could potentially inform policy changes as they apply to the research partnerships that we've worked on. But why do companies want to work with us? Some of these goals are overlapping, as you can see here in the green. Those are common goals often between the CFPB and the company. There are also other reasons why we've heard from companies that they are interested in working with us. One is this kind of halo effect. Basically, they want to kind of work with the CFPB. Of course, we're never endorsing the company, but just having this relationship sometimes can also spur further research interests, and other researchers or other financial institutions might want to join on when they see partners that are similar to them in the field, that kind of thing. Also, often the companies that we partnership don't necessarily have the research expertise to engage in this type of research that is also of use to them. And so we at the Bureau and the Office of Research have experts in randomized control trials, experimental design, as well as complex data analysis skills. And so a lot of the time, these companies are kind of using us in a partnership to kind of help them evaluate things of interest to them. That also relates to the next bullet related to subject matter expertise. Throughout the Office of Research, I would say particularly in my section, we have a lot of background in behavioral science and human decision-making, financial decision-making, and sometimes the companies don't necessarily have as much of that. And so we are also adding our research ideas and our research insights to the research questions and the projects. Again, companies often are also interested in policy changes, especially when there's the potential for a regulation to be improved or to change that might be helpful to their company. Next slide, please. And so anybody who's engaged in a research partnership knows it's a very rewarding experience, but it can be difficult to get off the ground, and it also often takes a long time to get from start to finish. And so this is just one slide that boiling that all down into these few bullets, though a lot of time and effort goes into these research partnerships. So first, what we do is we try to make connections. And so these can come anywhere from, the Bureau has lots of connections with the field through our markets team, as well as our consumer education contacts in the other divisions in the Bureau. And so a lot of time, that's where we find these research partners. But it can come from all different aspects. And so once we make connections with these potential partners, we then explore the partnership potential with the company. So what are our overlap in interests and priorities? Are we kind of on the same page with regard to what we're trying to learn? We typically generate many potential research questions and then narrow in on the feasible ones, both from our end and their end. And we also have important discussions related to the partners' capabilities. What type of data do they collect? What type of data can they actually share with us? What are the resources that they can put into the partnership? And what is their expertise? And how do our maybe different areas of expertise combine to make a research partnership that might be particularly worthwhile? Once we decide that there is potential and that we do want to go down the path of a research partnership with a particular entity, there are many logistical steps we need to go through. First, we do a due diligence check to ensure that there's that the partner would be a good partner for the Bureau to work with. Then we start engaging with our legal team to write up agreements and do legal review, so that we are all on the same page with regard to how we're going to get the data, what we're going to say, how we're going to publish, things of that nature are all part of these formal documents that go back and forth between the two groups. We also do a data intake review. We're obviously at the Bureau very careful to only take in the data that we need for the particular research questions at hand. And so we work with our data intake team to identify what those questions are and to make sure that we're not kind of housing a lot of data that is just going to sit there without the specific research questions in mind. And then, of course, throughout, we're communicating with leadership related to the feasibility and the interests and the Bureau priorities as it relates to the various projects. Slide, please. So this, I'm not going to go through this. This is just to illustrate some of the research partnerships we've worked on over the time at the Bureau. Again, I mentioned American Express and H&R Block. Those were both related to saving on prepaid cards. Credit Karma, I already mentioned, related to financial well-being and credit reports. And Patrick is going to go into these last two green lines on the bottom. Those are our two most recent current partners. Slide, please. Great. So I'm going to kick it off to Patrick in a moment, but let me just give you a little preview of what he's going to talk about. Right now, we are engaging with two partners on data partnerships. So these are studies where we are bringing data into the Bureau from companies so we can inform a previous Bureau priority area, but still of interest. We're examining consumers' experiences and interactions with a savings goal product. And the Bureau is being provided administrative data to answer questions of mutual interest, such as what are people saving for and how do different goal types affect saving? What rules do people set up to help them save? Do some types of rules lead to greater likelihood of goal completion? And how has saving related behavior changed since the onset of the COVID-19 pandemic? And what's interesting about these research questions and any research questions that you try to formulate during a research partnership is they're very fluid. So we go in with very specific research questions that the company and we are mutually interested in. But as you start to get in the data, as you start to explore what is and what is not possible, some of these, change a little bit. So this is where we are now. And Patrick is going to give you some more information about the preliminary findings from these exciting partnerships.
Hi, everyone. We can go to the next slide, please. Awesome. Thanks, Melissa. Hi, everyone. I'm Patrick Heck. I'm a research scientist in the Office of Research. I've been involved in the partnerships work. I'm really excited to get to show you some preliminary results from our data partnerships. The first one I'm going to talk about today is Southern Bancore. This is a large community development organization in the southern US. They have over $1 billion in assets, over 60,000 customers in many traditionally underserved regions, including rural and urban. Southern Bancore offers savings features, including rules like transaction roundup, automatic transfers, and they also offer customers the opportunity to define their own savings goal. So to open a savings sub-account and type in the name of what they're saving for and set a target amount that they want to be saving. Southern Bancore has shared with us account balance information, savings goal information, and individual account level specific transaction data between 2019 and 2021 for a sample of their customers. Next slide. Here are just some preliminary results. This figure displays median account balances among Southern Bancore customers at month end in all of the months for which we have data. The y-axis here is dollar amounts, and this is for all 3,365 accounts that we have access to. This includes accounts that have savings goals attached to them and accounts that don't have savings goals attached to them. The vertical line there is the onset or the declaration of the COVID-19 pandemic, and you can see to the right of that line that balances appear, on average, to increase after the declaration of the COVID-19 pandemic. I just want to say that as part of this kind of fluidity we have in these partnerships, we are in an ongoing discussion with Southern Bancore to receive a larger sample of their customers. And if we do end up obtaining that larger sample, we would expect some of the noise in these bars to decrease for this hopefully pattern to smooth out. Again, this is a preliminary result. Next slide, please. Okay, this displays median monthly credit amounts or dollars flowing into the accounts for Southern Bancore customers. Note the spike there in April 2020, around the time the first economic relief payment went out. As before, we see a slight increase in the bars to the right of the line compared to the bars on the left of the line. This suggests that a slightly larger amount of money is flowing into accounts after the COVID-19 pandemic rather than before. Next slide, please. This shows here median monthly debit amounts or dollars flowing out of the accounts. Again, we see a similar pattern where the bars to the right of the line are a little bit taller than the bars to the left, suggesting that people's spending amounts or debits are also increasing after the onset of the pandemic. Next slide, please. We're actually going to go ahead and skip this and the next 3 slides, just for time's sake. And one more, please. Thank you, that's perfect. Okay, we do have several remaining questions, some answered, including by the table we just skipped for time's sake. But right now we're engaging with a couple specific questions. What trajectories do customers' account balances take over time? Do these account balances increase, decrease, or remain consistent, really when we're looking at the specific customer level or the specific account level? And how did the COVID-19 pandemic affect these trajectories? Did it take the shape more of interrupting people's trajectories towards savings or accelerating the trajectories that they were already on? Second, we're interested in how the economic impact payments and the new child tax credit payments affect account balances, savings, and spending. This is another part of an ongoing discussion we're having with Southern Bancore about accessing new data, specifically these child tax credit payments that have just started to come out. Next slide, please. Okay, I'm going to move on to our second data partnership here. This is with a savings app provider. This is a savings app that's very popular. It has highly customizable savings goals that it offers to customers, rules that customers can set for themselves, and lots of different automation options. So some examples of the features that people might wish to customize include the target amount that they'd like to be saving, the target date they'd like to achieve their goal. Customers are also able to go in and type a name for their goal, and they can even attach a photo to the goal, perhaps to motivate them for saving. Some of the automation examples are these savings rules that people can choose to set for themselves. An example might be save some amount of money every payday, where that amount of money is variable and customizable for you. It might look like save every time I send a tweet, save every time my daily steps exceed 10,000, save with every purchase I make at Ben & Jerry's. So this partner has shared with us a large amount of savings goal data, including the labels that customers assign, the amounts in those goals and their target amounts, transfer events, the savings rules that customers choose to apply, and more. Next slide, please. Okay, this is a figure displaying the 40 goal category labels within the data set we're working with. What I mean by that is that in previous work, our partner used a machine learning algorithm to take the text that customers typed in to assign to their goals and categorize that text or those goals according to one of these 40 categories here. And so that top category there, the most popular one, Savings General, has almost 140,000 unique goals associated with it. Some other popular goals are travel and vacation. There's an auto-generated goal there, on down through debt, events, holidays and gifts, transportation, etc. Excitingly, interestingly, we're able to track inflows and outflows into these goal categories and specific goals, the rule types that people use, goal target amounts, canceled and overridden transfers or transactions, and more. I think based on these counts, the sample size here, we really have sufficient sample size to look at savings both across these 40 rules or these 40 goal labels and within them. We also have access to quite up-to-date customer data here with this partnership. Next slide, please. Now I'm going to show the popularity of two of these specific goal labels. These are up near the top here of that figure. These are centered around the declaration of the COVID-19 pandemic there at March 2020. First, I'll show the label emergency savings. The bars here correspond to the percent of all new goals created in a given month. And so this is really the popularity of these goal labels as a share of all goals being created at the monthly level. Note the increase here in popularity for emergency savings around the time of the pandemic. Next slide. Next, we can look at a similar analysis of goal popularity, this time for vacation savings. In contrast with the previous goal label, here we're seeing a steady drop-off around the time of the COVID-19 pandemic. These two popular goal category labels suggest a rise in emergency-related savings and a decline in vacation-related savings with the emergence of the COVID-19 pandemic. Of course, these are preliminary results. These are illustrations. It's just two of the 40 goal category labels, and it's a bit of a coarse glance here. It's still kind of fun to see the data taking shape. Next slide, please. So as Melissa mentioned, one of our main research questions here is what goals and rules and combination of goals and rules are most predictive of success in savings. Some of the specific questions that we've been grappling with in the recent weeks include, how do we go about defining savings goal success? Is it total dollar amount saved in a goal? Is it the percentage of a goal target that a customer hits? Or is it stickiness? That is how consistently people save for a goal, or how people are able to resist perhaps drawing down from the goals they set up for themselves. We're also pursuing a more top-down or hypothesis-driven approach to categorizing these goal labels. And so one example of something that we've been discussing is looking at goals that might be motivating or maybe more quote-unquote fun versus more pragmatic goals. An example of that is saving for a new car might be more motivating or quote-unquote fun than something mundane like saving for car repairs, mundane and pragmatic. Another example is saving for vacations compared to an emergency fund, as well as this puzzling behavior of saving to pay down debt. So that debt category we have might give us an interesting window into this behavior where people set aside money to later pay down their debts. We're also looking at goal specificity. Are goals that are established with round numbers, for example, save $1,000, more successful or less successful than goals that have specific dollar amounts, like $989? The latter there suggests that there might be a particular product or service in mind that the customer is saving for. Next slide, please. Here are some takeaways and general themes from these data partnerships. To summarize the preliminary results we've seen today, soon after COVID-19, we see an uptick in account balances, spending, savings, and emergency fund related savings goals. This is a preliminary finding, of course, to be confirmed in both partners' data sets. Another theme here is that partnerships really require flexibility, and this retrospective administrative data rarely fits neatly into specific research questions. This goes back to the fluidity that Melissa was talking about. These are just some illustrative or hypothetical examples here. We might struggle to get specific transfers between sub-accounts in ways that we didn't expect. Certain transactions might be archived before a set date. There might be market timing around specific products and goals that change the way people save without us being able to observe that. There might be randomness and representativeness issues of the samples that we're looking at. A company or a business might change their model. For example, an organization might introduce a paid subscription service at some point. There might also be non-random fluctuations in customer bases or user counts. I just want to wrap up on this third bullet point here with a lesson that I personally have taken away while working on these partnerships. Perhaps naively, I thought coming into some of these partnerships, when someone says data partnership, that might look like a simple exchange where a partner or an organization kind of hands us a data set and then we hand back clean analyses and a full report on their data. In reality, these partnerships have operated much more along the lines of a dynamic research partnership. For both of these administrative data sets, our team meets regularly with both of our partners to help understand the data we're working with, to start to feed back results to the partners and make sure that what we're observing is consistent with our partners' understanding of their own organization. And we continue to iterate through different data sets that use slightly different sampling approaches or data structures to help us run our analyses in the way that's most informative. So the lesson that really I'm taking away or have learned in working with partnerships here is that data partnerships really are research partnerships. We can go to the next slide, which concludes my basic presentation of results here, and I will hand it back to Melissa for our discussion and Q&A. Thank you.
Thanks, Patrick. I hope you all are excited as we are to see some of these taking shape. It's very exciting, especially after, as I mentioned, it takes a long time to get to. So congrats to everyone involved in all of these research partnerships. So moving on to our Q&A with the ARC members. As you can see, these questions are in front of you. If one of them sticks out to you that I haven't gotten to yet, feel free. We have about 20 minutes, so I just want to make sure everyone gets to say what they want to say. But the first question I'll start with is, how do we build on existing partnerships? So as Patrick just mentioned, our two research partnerships are really, as he noted, they are research partnerships, but really they're data agreements. And how do we maybe morph that or kind of move forward into potentially more causal questions around how, RCTs and A/B testing, how do we potentially move into just a pure data agreement to more of an experimental approach? Any pointers there would be great.
Michael, do you want to jump in?
Sure, and thanks, Melissa and Patrick, for a very interesting presentation. I can see why you guys would be salivating at the prospect of some more of these sorts of arrangements. It's a great opportunity to learn. I guess my question, it's probably a couple of questions rolled into one. I'm curious about whether there are limits on these partnerships. For example, I can imagine a lot of companies wanting to test some of these kinds of products, thinking that they may roll them out at some point, as their own products, these savings products that are tied to various things. Are the results out of this, any aspect of the results proprietary? Or do you guys, when you engage with them, are you sharing basically all the knowledge? And sort of stepping back from that question a little bit, is the objective here to be able to disseminate what works and what doesn't, kinds of insights to encourage, to the extent that you find things work, to encourage other sorts of savings encouragement programs?
Great question. Yeah, from our perspective, we're in the business of evidence-based policymaking, and so we are always doing these research partnerships with an eye toward disseminating the findings, what works and what doesn't work. And to that end, you would imagine that some companies may not want their name associated with some failed tool or app or something of that nature. And so part of what goes into these data agreements and these other legal agreements is we state that we are going to share the findings, but they have the ability to say we don't want you to put our name on it. And so we would just say, kind of like Patrick did here, that's not the case here. But as Patrick just mentioned, a savings app provider or something of that nature, where we in these agreements reserve the right to disseminate, but not necessarily call the company by name.
And so just as a quick follow-up, if during the course of the project, they sort of discovered a secret sauce, it's kind of too late at that point, right? Because that'll get disseminated. I'm just wondering if there would be some hesitancy on the part of some companies who are really thinking this could be a great product for us. We don't want the rest of the world to know too much about what really makes it work. Have you had those kind of discussions with companies? Are they clear?
That's a great question. I mean, we wouldn't necessarily, I think it can be a back and forth about what we publish. I think we really, stick to, we're not going to kind of like shroud results or lie about anything of that nature. But I think that there are certain things, like for example, ways that we can describe the data. So instead of saying the number of customers somebody has, we can say the share of something, or, we can work around some of the things that might be particularly sensitive. And there probably, I have not encountered this, so this is a good question. There probably would be some back and forth related to like the best way for us to share the information that doesn't, reveal some sort of proprietary formula or something of that nature.
Can I just chime in as well and say that I think these data partnerships to a large extent are an exercise in relationship building. And so if you think back to that slide that Melissa showed with the arrow, I mean, some of these we're starting at that very basic beginning part of the arrow. I think potentially with the hope that through transparency and rigorous work and good relationship building, we'll be able to move more toward an open and transparent sort of evidence-based evaluation approach. And so very fluid, very ongoing, with sort of an end goal in mind that I think we're doing our best to set up at the beginning of these data partnerships with the organizations we're partnering with.
Okay, thanks.
Should also note, related to that, any time that either we are going to go public with a finding or the company is going to, say something about working with the CFPB, we have within those agreements this time period where the other party reviews. And so I have not really encountered much of like, it's only been don't say our name as opposed to like some argument about whether we share things or not. But that is part of, there is this review period. And so nobody's surprised in either direction.
I've got Tom and then Terry. Tom, do you want to jump in?
Yes, I'm a big believer in looking at the data and seeing it and whatnot, but to provide really good quality evidence-based policy, we have to have models that we're testing. We have to have statistical differences among groups that we're looking at. Now, in my own work with companies and state legislators and congressional staffs, they are interested in pictures. Pictures are very important, but underlying the pictures, before a picture can be shown, I think it's imperative to say that this picture is based on statistical differences, and I hope that the ARC can help provide that type of. You have plenty of PhD economists who are trained that way, and I understand the pull on the CFPB is to prepare a report yesterday, and I didn't know that until I started working with the research group at the CFPB, and I appreciate that because it seems like we're always in a hurry to make a decision instead of taking the time to look at a policy or a question in a very deep way and build a mosaic of many results through many samples and see what seems to be going on in terms of consumer credit markets and et cetera. So I'm glad to see the emphasis or the ship turning toward building alliances with companies and academics, and that is to me is a terrific thing to do. And I hope that the CFPB invests heavily in adding more research capability over time. So, but thank you for your presentation.
Yeah, thank you for your comment. And I, of course, can reassure you that we do have several economists. I'm a psychologist myself on these projects, and so the models are coming. We really wanted to be able to get the very first taste of the data out today. So I hope that I can earn your reassurance in the future that we'll have the statistical rigor to follow this up.
Yeah, and as I said, I'm a big believer in just saying we got to wallow in the data. We have to look at it. We have to throw it up on a graph and see what type of things might be going on, because the theory and empirical are interwoven. And so I didn't mean to suggest that what you did was anything different than what I would do with a new data set. So I'm really glad to see that you're pursuing collaborations with companies, and I hope to see more of it down the road.
Yeah, thanks.
Terry, you are next in the queue.
Hi, everyone. Thank you so much for your presentation. I want to say just one thing that I think has been a theme for me across our conversation this afternoon, which might not relate so directly to your presentation, but then I do have a point. I've just been thinking as we've been talking about credit card utilization, mortgage market, here thinking about saving strategies, how, you know, across the pandemic, which has been part of a topic of our conversation, has been you know, how people are experiencing financial distress. And I think just to keep at the top of our minds how people, how the pandemic hasn't been the only thing that's been happening over the last, you know, year or two. We've also had, you know, big political shifts, protests for racial justice, of course, unemployment, health, you know, health concerns related to the pandemic and otherwise, and a number of environmental things happening, and, you know, thinking about the kind of historic flooding that Detroit has been experiencing now for the maybe third time this summer, and all of those things, you know, people are carrying on their shoulders or carrying in their finances. So beyond the pandemic, all of these other things are happening simultaneously. And so that I've just been thinking about across our conversation, but more specifically, I was really excited to see the data from Southern Bancore, which I think, you know, you mentioned as a community development financial institution. I don't know if it's also categorized as a minority depository institution, but a mission-driven kind of financial services provider that, you know, seems to be really committed to serving folks in the South, you know, particularly in areas where Black people are living in rural areas, and to invest in, you know, farming and a range of activities. And so this seems to me like a really fruitful partnership. And I'm excited to see that it's developed with the work of the CFPB, in addition to the specific data that you're able to explore together. And I think the first question about how we build existing partnerships, I mean, you kind of already answered this seems to be an opportunity to build trusting, transparent, reciprocal relationships, you know, with the companies or with the groups, you know, that you're working with, because I imagine that this could be, you know, the beginning. This seems to be the kind of partnership you could develop, and just the beginning of what this one might offer, should you be able to work together well in a way that serves kind of both parties, and advance some of the, you know, some of the kind of mutually beneficial goals that you might have. So I would be looking forward to, you know, seeing future work that comes of this. So thank you.
Thanks, Terry. Actually, I think that's a perfect segue into the second question, if you want to hang on for a sec. What kinds of partnerships should we pursue to inform existing and emerging Bureau priorities, as you well know, related to racial equity, vulnerable populations? And so the Southern Bancore project started as a savings-related project, and they are very much interested in savings. But I'm interested to what are some other, like, you know, areas or like types of companies, types of institutions that you and others on the ARC might think would be ideal for kind of pursuing these current and emerging Bureau priority areas.
Yeah, I would think, I don't know if Southern Bancore was involved in the PPP loan program, but that, that might be a direction to explore, at least with that partnership. There are a range of activities happening around developing like community loan funds, Bank Black USA, which is, working on supporting Black-owned banks and investing there. And nonprofit organizations like Changemaker that May Watson wrote is leading, seem to be the sorts of partnerships that might be able to, build off of this work and support the priority areas that the Bureau's exploring.
I know we had two others in the queue, and we are quickly approaching the end of time. So let me, I know Tony, I saw you in there, and also Vicky. So Tony, did you still have a comment or question or response?
Yes. We all want people to buy insurance that will support their families if they die, especially obviously if they're a major support of the family. Of course, insurance that pays off if you die is death insurance. You can't sell death insurance. People will not buy it. Therefore, we call that insurance life insurance. And in order then to sell insurance that pays if you live, we have to call that an annuity. Now, as a professional economist, I regard this as problematic. On the other hand, as social policy, it's absolutely essential because we want people to buy insurance that will support their families if they die. And we would also like people perhaps to consider supporting themselves in their old age. Okay. So this language thing is real important. And of course, the people who are on top of that are Kamian, Thaler, and Sunshine, right? We've got the book Nudge. I would use that as a model, okay? And when I'm doing research, I would not let the partner define what I do. I would get a research idea and then pursue the partner. And the reason for that is, as I always tell my students, when you're dealing with social science data, if you start with the data and then try and find a hypothesis, you will always find a hypothesis and it'll usually be wrong. Because in social science data, you get all these false correlations that you don't understand. Your only hope at the truth is to start with theory and then go out and recruit your partner. Okay, that's the way Thaler and Sunshine did it in Nudge. There's a bunch of guys at Chicago Booth who have been doing this in different contexts. And I've never done it, but I would really consult with them and I'd follow their research technique, okay? So you get your idea of something where you think people are confused. Here's one of my favorites, and then I'll shut up. We really would like people to deal with fiduciaries when they do their financial planning. But we call them fiduciaries. I mean, to me, the word fiduciary sounds like someone you would go to remove a wart. You know, I went to my fiduciary and they got the wart. I mean, why the hell fiduciary? I mean, I understand, the accountants and we economists. I mean, come up with another word, right? And I bet you a lot more people would deal with fiduciaries and they would come up with a lot better life outcomes. So that's my advice to you. And it sounds like I'm kidding around, but I'm actually kind of dead serious. In fact, I bet you if you contacted, Thaler, he would even come up with some good ideas for you.
Thank you. We are aware of all of that research, and we agree that all of that's particularly important. I will say, to my earlier point related to data sharing fits in with that, where we are always very careful to have our hypotheses up front, and the Bureau as a policy, again, doesn't just like take in all the data that we could possibly want. So it is guided by our research questions, the type of the data, and also, of course, taking a step back, finding the research partners in the first place are also, guided by our priorities and our hypotheses and research questions as well. But I certainly take your point and agree with a lot of what you. Thank you.
It's outside the scope of this particular talk, but we also run lab studies. I mean, we have that mechanism to generate the hypotheses and test the hypotheses in the lab, and then bring them with a twinkle in our eye or a hypothesis that we have for an organization that we would hope to be able to test in a way that they're motivated to let us study rigorously. Yeah.
I think we've got just enough time. Vicky, I had you in the queue. Just enough time to get your comment or question in response before we close out. So, Vicky, are you?
All right, thanks, Josh. So thanks for a great presentation. I think this is very exciting. I just had three kind of questions, two questions. One is, I saw in your slides that you're really interested in kind of getting towards RCTs, which I think is really exciting. What appetite do the firms have for doing RCTs with the CFPB? I would be curious to see, because I think that's really a powerful tool that you could use to test various, hypotheses that you have. And the other thing that I wanted to mention, within the household finance field, a big trend is to try to, collect data from a company that can be linked with existing data sources. And so to what extent are you trying to develop partnerships where you can link, new data collected with some existing data sets that you have at the CFPB to be able to answer new questions?
So I can say a little bit about your first question, sort of stomach and tolerance for RCTs. And it's always intriguing to me that when you work with a firm or a company, they are very quick to talk about their A/B tests, right? People run A/B tests quite regularly, and many times when you raise the idea of running an RCT, they can get spooked, or that might scare them. So I think a large part of this is working with people and building those relationships in that way I was talking about before, where you aren't going to propose something that people might find aversive by calling it an RCT or something like that, right? So meeting companies and firms halfway, using the language that they're using, I think is one step we can take to try and set those up. As far as my actual, experience with these particular partners, the partnerships they still feel very new in a way where we maybe haven't raised some of those questions closely or specifically enough with them for me to be able to speak to their interest in pursuing those things.
I'll add, though, that some of the partnerships I mentioned early on, the American Express, H&R Block, those actually were RCTs. And so we've had success with those in the past. We didn't put on here, but there's another partner we're working with that we're hoping to launch an RCT in several months from now. So it's just, I think, as Patrick mentioned, kind of working with the company to see what they're comfortable with. A lot of the time it's, as he mentioned, kind of getting them comfortable with the concept of a control group, or, withholding potentially what they think might be the best thing for their customers. And then, we start to talk about, well, we don't necessarily have to fully withhold. We can roll it out in different ways. So it's an ongoing conversation. But I think we've had good success in the past with kind of working on these RCTs with other companies as well.
My biggest responsibility as ARC chair is to get us out on time, and so I'm gonna nail that part. So thank you very much, Melissa and Patrick, for a really awesome presentation, and thank you everyone and ARC members for your comments and questions. We're now at time, and with that, I will adjourn today's call. And Manny, I will kick it back to you.
Thanks, Josh. And I'd also like to thank my Bureau colleagues today for presenting. ARC members, we also appreciate your feedback and comments throughout the day. I'm certain that the Office of Research has benefited from today's engagement. Lastly, thank you, Josh, for moderating the meeting. Sadly, Josh Wright, Mike Bay, Terry Friedline, and Tom Miller will be rolling off the ARC this fall. We really appreciated all of your contributions during your tenure. Do not worry, we will still engage with our alumni. We have your cell phones and might be calling on you. So stay tuned for that. Looking forward to working with the ARC Vice Chair, Vicky Bogan, in the near future. She'll be becoming the ARC Chair later this fall. And with that, once again, thank you all for connecting today. And with that, Tracy, we may disconnect at this time.